will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samir Desai from JM Financial. Thank you, and over to you, sir.
Thank you, Rutuja. Good morning, everyone, and welcome to the 3Q23 earnings conference call of Bajaj Finserv. I would like to take this opportunity to thank the management of Bajaj Finserv for allowing us to host this call for yet another quarter. From the management team, we have Mr. S. Srinivasan, CFO Bajaj Finserv, Mr. Tapan Singhal, CEO Bajaj Allianz General Insurance, Mr. Tarun Chugh, CEO Bajaj Allianz Life Insurance, and CFOs Mr. Ramandeep Sahani from Bajaj Allianz General Insurance and Mr. Bharat Kalsi, CFO of Bajaj Allianz Life. We will open the call with opening comments from Srinivasan sir, and we'll move to Q&A. Over to you, sir. Thank you so much.
Thank you. Good morning, everyone. Welcome to the conference call to discuss the results of Bajaj Finserv Limited for Q3 of FY22-23. Before I get into the performance, let me just make some standard hygiene announcements. As before, in this call, we will largely be concentrating on the consolidated results as well as the results of our insurance operations through Bajaj Allianz General Insurance and Bajaj Allianz Life Insurance, BAGIC and BALIC respectively, and where material, the standalone results of our company, BFS. Bajaj Finance Limited, which is another major subsidiary of ours, has already had its conference call. However, if there are any high-level questions on BFL, we'll be glad to take that as well. We will not be taking any questions on the status of Allianz's stake in our insurance companies. The status has remained the same as at the end of the previous quarter, and there is no change there. Any statements that may look like forward-looking statements are just estimates and do not constitute an assurance or indication of any future performance result. Brief remark on Ind AS. As required by regulation, BFS prepares its financials in compliance with Indian accounting standards or Ind AS. The insurance companies are not yet covered under Ind AS. They have prepared the Ind AS financials only for the purpose of consolidation. Accordingly, for BAGIC and BALIC, the standalone numbers reported in our investor presentation and which will be discussed below are based on the non-Ind AS accounting standards or Indian GAAP as applicable to insurance companies. Our results, the press release accompanying the results, and our investor presentation have been uploaded on our website yesterday. Let me now come to the performance for Q3 FY23 and the 9 months FY23 where relevant. Let me start with BAGIC. For the quarter, BAGIC reported a growth of 28.6% in gross domestic premium income, as against the private sector growth of 22.3% and the industry growth of 18.5%. Even if we exclude the tender-driven volatile businesses, basically crop and government health businesses, BAGIC has grown at a fairly healthy 12.8%, and for 9 months it is 14.6%. In the intensely competitive motor segment, BAGIC has been selective, seeking to grow in counters with high profitability. To add some more detail, the growth in GDPI was attributable to retail and group health, which grew at 11.2% and 41.2% respectively. Commercial lines, fire, engineering, marine and liability at 14.9%, and overseas medical, which is travel insurance, at 44%. Overall, in Q3 FY23, BAGIC had a motor growth of 6%, the two-wheeler segment growing 24%, while the four-wheeler segment grew 8%, and the CV segment degrew by 5%. Specifically, BAGIC chose to give up business in larger cities where price competition was more intense. The growth in commercial lines was aided by BAGIC's strong bancassurance network and multi-line agency channel, supported by strong underwriting and large reinsurance capacity for covering large risks. BAGIC continued its robust performance across retail, commercial and industrial risk categories. Fire and marine segments continued their growth momentum. Engineering and liability lines have also shown strong growth, continuing their momentum from the previous quarter. Overall, commercial lines continue to do well with Q3 FY23 and 9 months FY23 growth of 14.9% and 15.2% respectively, against the industry growth of just 8.3% and 14.4%. Health insurance performance has improved in Q3 as compared to previous quarters of FY23. Overseas medical or travel insurance continued its momentum, growing at 44%, while Bajaj growth in retail health at 11.2% was better than the overall market, which is private public players of 10.1%. In group health, Bajaj witnessed strong growth of 41.2% in Q3 FY22 versus industry, private and public players of 30.6%. For the industry, overall retail health growth, including standalone health insurers or SAHIs, was 32% in Q3 and 25.2% in 9 months of FY23. A positive feature in Q3 of FY23 was on the claims front, where sequentially from Q1 FY23, the claim ratio has improved. It first improved by 2.4% in Q2, and then it has further improved by 3.4% in Q3 due to better selection of business and normalization of aberrations such as high motor own damage loss ratios. If you recall in Q1, when we had a fairly spike in our loss ratios, we had said that we will be taking corrective action to bring down the loss ratios. And typically in a general insurance business, these take 6 to 9 months to play out because the existing book will continue to have higher losses while the new book will be returned with stronger underwriting. And the results of that are already visible. For Q3 FY23, the loss ratio stood at 72.1% as against 69.6% of Q3 FY22. The increase was attributable to high inflation in motor and health segments, partially offset by lower commercial claims. Moreover, Bajaj has also taken an additional net impact of 9 crores on account of the adverse court order with respect to the Osmanabad Kharif 2020 crop season. At this stage, we do not have any information which makes us to believe that there is any further provision is required in respect of the Kharif 2020 crop season. The combined ratio for Q3 FY23 stood at 100.3% versus 98.9% in Q3 FY22. Nevertheless, higher frequency in motor and health ex-COVID and the impact of inflation on cost are expected to remain. Bajaj will monitor these developments closely and endeavor to initiate corrective action as required. In a market where most companies are reporting large underwriting losses, this result, we believe, displays Bajaj's commitment to a balanced and profitable growth on the back of strong underwriting and selection. The profit after tax was at 278 crores in Q3 FY23 and 1,026 crores in 9 months FY23. The AUM grew by 8% to 25,977 crores for the 9 months ended 31st December 2022. The lower PAT is mainly attributable to higher combined ratio and lower realized gains on investments. Clearly, the realized gains on investments quarter on quarter can be volatile, and this quarter it was a bit lower than the same quarter of last year. In summary, it was a quarter with strong external headwinds in the form of price competition in motor segment, and Bajaj has chosen to hold its own with a satisfactory combined ratio. I will move to life insurance next. Overall, the life insurance industry saw momentum pick up in Q3 after a muted Q2. During the quarter, while few private players saw slowdown in their growth as compared to the previous year, Bajaj continued its month-on-month growth trajectory and reported an industry-beating individual rated premium growth of 22% against the industry and private players' growth of 12% and 16% respectively. Similarly, in the 9 months of FY23, Bajaj's IRNB or individual rated new business grew 38%. As against the industry growth of 16%, private players growth of 19%. In fact, in the 9 months of FY23, Bajaj was the second fastest growing life insurer among the top 10 private players on the IRNB basis. And on a 3-year CAGR of 35% on IRNB basis, Bajaj remains the fastest growing life insurer in the industry. This compares with the pre-COVID base. Bajaj improved its market share of IRNB from 6.4% to 7.4% among private players in the 9 months. Total number of policies for Bajaj also grew 24% to 1.52 lakhs in Q3 FY23. And for 9 months, the growth was 33%. And as of 31st December, in the 9 months ended 31st December, we have issued 4.09 lakh new business policies. Overall, IRNB mix for Q3 stood at par 19%, non-par savings 37%, term 4%, annuities 7%, and ULIP 33%. As we mentioned before, BALIC's primary differentiator in the market is balance. A balance across products, a balance across distribution, and a balance between profitable growth and profitability. Most lines, including par, non-par savings, term, annuity, and ULIP, have shown growth in absolute terms. The business mix changes reflect relative differences in growth and hence are not a matter we are concerned about in the short run. During the quarter, growth was driven by all our main channels, with agency, institutional business, and BALIC Direct growing at 28%, 18%, and 15% respectively. Another point I would like to highlight here is the strong year-on-year increase in persistency across vintages, especially in the later buckets, where 49-month persistency increased by 4% to 63%, and 61st month persistency improved by further 3% to 49%. As a result of the actions taken on persistency over the last few years, our renewal book is looking quite solid, and we were able to record a 30% growth in renewal premiums in Q3FY23. New business value, net of expense overrun, the key metric of profitability, increased by 38% from 152 crore in Q3FY22 to 210 crore in Q3FY23. For the 9 months ended 31st December 2022, the NBV was 535 crore as against 314 crore for the 9 months ended 31st December 2021. This is a growth of 71% in the 9 months. BALIC's PAT for Q3FY23, that is the profit after tax, degrew by 8% to 81 crore as against 88 crore in the Q3FY22, mainly on account of the higher new business strain given the higher growth in new business, and it was partially offset by lower tax claims. Last year we had a few reserving for COVID claims. Overall, a relatively strong quarter for BALIC. Finally, both insurance companies are financially among the most solvent. BALIC with 529% solvency and BAGIC with 373%. And they are both well poised to weather any external adversity. All our businesses are further augmented by digital capabilities, which along with greater digital acceptance by customers should, we hope, help create the foundation to deliver a strong performance in the last quarter of FY23. Both BAGIC and BALIC have seen an increase in the utilization of the digital properties by customers and intermediaries. Further details regarding BAGIC and BALIC's digital capability are covered in the investor deck uploaded on the website. I would urge everybody to go through the same in detail. Coming to our lending businesses, BFL and BHFL. BFL already had its investor call, and we will only broadly touch upon BFL results. Both Q3 and 9 months of FY23 were excellent for BFL as the company delivered on all its long-term financial guidance metrics, AUM and profit growth, return on assets, return on equity, as well as gross and net NPA. The return on assets on an annualized basis is about 5.4% now. Continuing on its growth story, BFL acquired 31.4 lakh or 3.14 million new customers in Q3 and 84.8 lakh new customers in 9 months of FY22. Building on this customer franchise, the number of new loans booked in Q3 FY23 increased to 7.84 million or 78.4 lakhs as against 7.44 million in Q3 FY22. The company's diversified business model has enabled to record strong AUM growth as seen from the total AUM standing at 2,30,842 crore on 31st December 22 as against just 1,81,250 crore on 31st December 2021. BFL continues to maintain a management overlay provision of 1,000 crore at a consolidated level for COVID and other unexpected contingencies. The gross and net NPA continue to be under control, with the gross NPA for BFL as being 1.14% and 0.41% respectively. BFL ended the quarter with a profit after tax of 2,973 crore on a consolidated basis, which was 40% higher than the same quarter of the previous year. The capital adequacy continues to be strong and stood at 25.14%, out of which the Tier 1 capital stood at 23.8%. One of the strong performers in the quarter has been Bajaj Housing Finance, the 100% mortgage subsidiary of BFL. It continues to do well. The AUM grew by 33% to 65,581 crores as at 31st December 22 from 49,203 crores. Profit after tax grew by 81% to 334 crore in Q3 FY23 as against just 185 crore in Q3 FY22. For the 9 months ended December 31st, the profit after tax grew 87% to 956 crore. The capital adequacy ratio is fairly comfortable at 23%, with GNPA and NNPA continue to be under control at 0.23% and 0.10%. In summary, a very strong quarter for both BFL and BHFL. Consequently, the BFS consolidated results reflected an all-time high quarterly profits. Now, I'll give you some update on our newer companies, which is Bajaj Finserv Direct or Bajaj Markets and Bajaj Finserv Health or EBH as we call it. During Q3 FY23, Bajaj Markets attracted about 84 lakh consumers on its digital platform, of which about 2 lakh became customers. This is as against 80 lakh and 2 lakh customers in Q2 of FY23. BFSD lending, the lending of Bajaj Markets, unsecured and secured, both BFL and partnerships, the disbursement for the quarter stood at 1,175 crore as against 1,052 crore in Q2 FY23. It also sourced 62,000 cards in Q3 FY23 as against 61,000 cards in Q2. In Q3 FY23, Bajaj Markets reported total income of 104 crores. This is the revenue that they have earned versus 56 crores in Q3 of FY22. For the 9 months ended 31st December, the revenue was 278 crores. Coming to Bajaj Finserv Health, during Q3 FY23, Bajaj Finserv Health carried out 9.1 lakh health transactions, having 3.9 lakhs plus monthly active users. For the quarter, EBH had 9.74 lakh paying users, with 3.1 lakh users having renewable products. EBH is also managing OPD benefits for over 250 employers, covering 2.2 lakh plus members under its managed care services. At the same time, EBH is powering Health Plan Rider product, which is sold along with Bajaj. It's a Bajaj product which offers OPD, teleconsultation, and various other non-hospitalization benefits. And I'm glad to say that this product, which was launched in January of 2022, has already crossed 10 lakh members, or 1 million. The company is now building wellness benefits as well as fitness, dietitian, mental health, and going forward over the next 2 years, we will see stronger focus on those areas, moving away from illness to wellness. In Q3 of FY23, EBH reported total income of 45 crore versus 28 crore in Q3 FY22, and for the 9 months, the total revenue was 117 crore versus 60 crore in 9 months of FY22. Now a brief on our consolidated financial results, the details of which are in our press release. Consolidated total income, 23% increase to 21,755 crores. Consolidated profit after tax, 42% increase to 1,782 crores. For the 9 months ended, the consolidated total income was up 18% at 58,447 crores, and consolidated profit after tax was 45% higher at 4,648 crores. Under the Ind AS, the insurance subsidiaries have chosen to hold a part of their equity securities portfolio as fair value through profit and loss account. What this means is that the unrealized mark-to-market gains on investments included in consolidated profit tends to be volatile. Although they are unrealized, we still need to make a provision in the books. So there were, on account of this, there have been MTM impacts. We tend to call this out separately so that investors can make an appropriate judgment about the core results. If one were to exclude the volatile impact of MTM losses and gains, the core profit after tax would have increased by 34% in Q3 FY23 and 57% in the 9 months. This, in short, is a brief on the results for Q3 of FY23, and I will now invite questions from the participants. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Avinash from Emkay Global Financial Services. Please go ahead.
Yeah, hi. Good morning. Few questions. First one, I would like to understand on Bajaj. I mean, how is the commercial lines pricing environment, particularly post there was some kind of, I guess, circular guideline by IRDA that says that the reinsurance or the GIC led price, for reinsurance does not set a kind of a floor. I mean, in a way, it sort of opens the door for competition as far as the floor pricing is commercial lines is concerned. So post that, I mean, how is sort of a commercial line pricing environment that's one. Second, on BALIC, on the group side of business, particularly if I see on the protection, if you can help us understand, I mean, the kind of slight decline in premiums, is it coming from the GTI or credit life, and is it volume or pricing led? And also on the fund management side, of course, that business is not profitable, but what is sort of driving this sort of that you are like many others are also ceding some business or rather doing less business on the group fund management side? That's two. And lastly, one would be on your hedging strategy. Of course, you have PRA and part paid bonds. I mean, how is the sort of a supply of part paid bonds, and what sort of a comfort you have, like what is your comfort in terms of the corporates, name of corporates where you can sort of subscribe to part paid bonds and all? Thanks. These are my three questions.
Yeah, thank you. I will just summarize the three questions. The first question was for Bajaj, where you want to know about commercial lines pricing because of the removal of the insurance to IID cap or a floor on pricing. The second question was to BALIC on the protection side with a focus on group protection as well, and what are we doing on the fund management side. And lastly, you wanted a view on the FRA. So I'll just pass it on to Tapan first to take the question on Bajaj, and thereafter Tarun will handle the question on BALIC.
Yeah. Last one was on part paid bonds. Okay, thanks.
Okay. Fine.
Yeah. Thank you, Srini. Okay, if you look at, let's understand what was this IIB rate to begin with. No? So GIC, our national reinsurer, had put in underwriting guidelines in terms of what it took accept in its books. It said that the average claims, which is part of IIB, you can get the data from IIB, is what the minimum it will accept in terms of its reinsurance team. So it is not that there are other reinsurers in the market who were free to write the risk at anything. So everybody has their underwriting norms. So I think it was a GIC underwriting norm in which they said this is what they would be looking for. Now, what as the regulations mentioned is that you cannot put in non-specific like this in terms of linking it to some part of it. So fundamentally, what was weakness in the norm was that good risk would also have to be priced. If you got a lower strata, they cannot go and get benefit of it. Now, with this coming in, there would be underwriting norms in which better risk may actually get better discounts. And the earlier times also, the worst of risk can be priced more aggressively. So it is just underwriting norms which were set up by GIC. It was not something which was set up by everybody across the industry as it was made out to be. And as I mentioned earlier, that other reinsurers do not have these kind of norms to show there. So the pricing will actually, in my view, let's see how the future holds up. For good risk, obviously the pricing would get much better, and for risks which are not so good, it will get better. So it has been something which was there just 2 years back. That's how the pricing used to happen. So I do not see a very huge shift in terms of fall in prices. There would be some fall in price because the good risks will be written at a much better price. So that will be there. But it will not be something that will be catastrophic in nature in terms of the way the prices would behave. It will tumble down completely. I don't see that happening.
Okay. Thanks.
Okay. Tarun here on BALIC. So the first question is around protection. I'll basically bifurcate this into two parts. One is credit life and group protection, and the other is on the retail side. On the group side, we've had a very kind of sedate first 9 months, largely because the partners we've been working with haven't really grown much. It's a unique situation that the partners who contribute to our significant percentage of credit life haven't really themselves grown. Market has grown faster in credit life. But on the retail side, where a lot of our focus has been, we've grown quite well, I would say. So if I just talk about the number of customers we've added, we had a 68% growth in terms of the number of customers we've added on the retail protection. The second question was, and that's quite healthy and quite as per the strategy that we had. In terms of the price, that was the second question. Pricing in credit life and group term life, which is the employer-employee, has now stabilized to, group term life particularly has stabilized to pre-COVID levels. And credit life, the prices have stabilized as well. In retail protection also, whatever price hikes we have done, we've mostly done with, and it's stabilized there as well. On the fund management side, I presume you're asking about the group employer-employee funds. It's not a very big focus business for us because the bottom line from that isn't really significant. But still, having said that, it's a profitable business for us. And we expect that to grow with every deal that keeps coming in the market. So it's a very lumpy business, difficult to forecast. And typically, it's very responsive to the pay hikes that we see in the market, because gratuity and superannuation, the contributions get linked to that. It is a line of business, but like I said, it's not something that we expect to really focus on too much. On the FRA, that is the third question. I'm asking Bharat to just respond to it.
Yeah, thank you. Thank you, Tarun. Thank you for the question. So the question was more on one is on the partly paid bond supply side as well as on the overall FRA. So I think FRA, as you are aware, that it's an established practice and we continue to follow that practice to hedge our portfolio. As far as partly paid bonds are concerned, we are already invested into few top corporates only. But as a process, you are right to a good extent that the supply side on the partly paid bond is less. But what we are trying to do is that we are trying to go to the first class or the category A manufacturing companies in terms of if they are okay to issue a partly paid bond. So this is more at a discussion stage, but we will be very calibrated in terms of taking any credit risk, and hence partly paid bond will always remain one of our key areas of hedging, but it all depends on which kind of a corporates are willing to issue the paper.
Yeah. Very clear. Just on the group fund management, is it the competition has intensified? I mean, particularly from the large incumbent in that segment. Is it the reason why you are, or like it is just that okay? So is it? I mean, that okay? Spread is compressed by the larger player in that segment.
Yeah, so that is correct. The incumbents' focus has been on this. They are quite good at this and have a very good spread of corporates. Our overall fund management base for group funds remains quite healthy, close to 10,000 crores. So as a overall portfolio, it does make money, and which is why we focus really on the bottom line here, but not necessarily significantly growing top line. We would like to keep profitable business on our books only.
Thank you. Very clear. All questions. Thank you.
Thank you. The next question is from the line of Bhavesh Kanani from ASK Investment Managers. Please go ahead.
Thank you for taking my question. My question pertains to the health insurance business under Bajaj. The share of retail health has been pretty low. So just wanted to get your sense on the strategic direction for this business. How do we look at the opportunity there, the profit pool, whether it interests us, and if so, what can be expected in terms of future growth from this business?
I will pass it on to Tapan to take that.
Thank you, Srini. So if you look at, I think retail premium, if you look at for the industry also, it is not the leading business. It will be mostly group health, government health, and retail. That is how it is structured at. Coming to Bajaj, in the COVID times, we had gone slow on retail health, if you looked at, because it was very uncertain. And if you see the losses happening in the health portfolio, it is very high, and the price correction was not happening at that speed as it should be. Now, if you look at it, the market has corrected prices to a large extent on the retail health basis, and we also had done some correction on it, as we had mentioned last time, about a couple of years back. And now if you look at our focus, we have been growing retail health. So we would remain focused on that. It depends how the market conditions are. COVID was a time of huge uncertainty. And that time we preferred to go slow compared to the market, simply because it was not very clear as to how the health portfolio would play out. But now if you look at, we are again growing our health portfolio and we are focusing on it.
Any targets or any roadmap you have in mind of what kind of contribution you would look to get from the retail health?
So for us, it's actually very simple as strategy. We are very agile. Whatever it looks good to us, we grow that more than the market. And what we look is not giving us good returns, we slow down the market. And you see in the motor itself, commercial vehicle at one time was giving us good returns. We grew over the market. Now if you look at the commercial vehicle is much slower than the market. So if the market, what we feel is good, we will grow over the market. And if we feel that it's difficult right now, we go below that. We don't try to fix targets and just go for it without looking at how the market behaves. So our response is how the market is behaving. So we're able to keep our motive of three things very clear. That is one, customer obsession. Come out with products which is very customer centric. And I would like to mention that if you look at the product we came out to solve the elderly care issue, the respect product for health, in which we have set up an IoT, a fall detection, a call center, and emergency ambulance to pick up elderly. Something goes wrong from their home and take them to the hospital to be treated. Even before the callers, on our own we get a call from the fall detection to our call center, pick them up. So we keep on pushing boundaries for customer excellence. I think again very first, and we heard Srini's opening talk. We came out with OPD also, a very strong product with collaboration with Bajaj Finserv Health. So we keep on pushing boundaries in terms of customer servicing and excellence. That's the first thing that we keep on doing, and we'll keep on doing as we progress also. The second thing that our obsession is, as I mentioned to you, that we will grow over the market if we feel the market is conducive and which is there. So we don't try to keep targets on it. We obsess with the customers, keep out with innovative products that is beneficial to society, and also keep on looking at market and keep on growing that. We'll keep on doing that as we progress further.
Okay, that's wonderful to hear. Any sense on where we are in terms of investing for expanding the retail health business? Any investments, plans you can share?
Yeah, so if you look at our distribution, we are expanding tier 2, tier 3. We have clear plan. So as we expand distribution, predominantly there are 2-3 lines of businesses get pushed. One is motor, one is health. So you will see this happening, with our expansion of distribution. So that is a clear investment that we are going ahead with, and which we have been doing consistently.
And last bit, what in your sense is a sustainable ROE for retail health business?
See, retail health is an interesting thing, and it's a good question. If you look at across the industry, currently the profit in the retail health portfolio comes from new business. So any company which is growing new business aggressively has a lower loss ratio, and the old book has a loss ratio which is pretty high. Now, that to me is not a business which is sustainable. All years and all books should be on a profitable basis. That is the way we look at it. And currently that's what's driven predominantly, which has driven a lot of companies to grow fresh very aggressively because that brings their books very good profit. If you look at the loss ratio for third or fourth year of their books, they will not be profitable. It will be a combined ratio over 100. So fundamentally, if you look at retail health, I think the balanced pricing and the solutioning which comes through is what will give a good ROE. Our obsession has always been to have a combined ratio which should be close to 100 in a market like this, and that is what we keep on targeting for all lines of business.
Just to add to what Tapan said, while there is a lot of focus on retail health, as Tapan pointed out, has a fundamental problem that everybody is depending on new customers coming in or price increases to be able to keep up with the deteriorating loss ratio as the customer profile ages. But the group health is an important thing, and Bajaj, over years we have been, when we felt the market was not conducive, we have slowed down. But when the market is attractive, we have been more aggressive. Whenever we get business on our terms, we take it. And overall in our group health, now we are able to operate it very profitably with a combined ratio below 100%. And that is also growing at 40%. So clearly, when we look at the overall health spectrum, it is about how much of the payments that you control, including group and retail. That is an important metric. And Bajaj stands fairly high in the pecking order on that. As the health insurance market evolves, I think both will have an important role to play. And the ones with better, because in group health you do have a chance that every year you get to re-underwrite the business. So it's not subject to acquiring new customers only. And it is also very service sensitive, being an employer-employee benefit. In both of these, Bajaj continues to invest and be strong. And we think that overall health business is doing quite well.
Okay. Thank you for your responses.
Thank you. The next question is from the line of Sanket Godha from Spark Capital. Please go ahead.
Thank you for the opportunity. Srini, I have a first question to you. Just your view on the composite licensing, given you the house Bajaj Finserv as a house has both life and general insurance, and where the ownership is common. So how do you see this composite license coming out? Whether BALIC will compete with Bajaj on health if they choose to do health. So just broader idea what you have on composite license. That's the first question. Then I have specific questions on BALIC and Bajaj. If you can respond that, then I can ask other questions. Yeah.
No, broadly, see, this is just a proposal now to change the acts, empowering IRDA to create subclasses of business and to offer licenses differentiated basis for people who want to do only certain class of business or more than one class of business. I believe that is now being under discussion with a large group of stakeholders, and we'll have to wait and see the final contours before we take a call. So at this stage, we cannot comment on whether it is a good thing or a bad thing. Clearly, prima facie, it looks like there are benefits of cost by sharing of branches and sharing of people. But at the operating level, at the risk level, I think the two are completely different businesses. So it's not necessary that just by combining the two, you actually get a superior business. And there is accumulation of risk across, say, health and life, for example. When a person falls sick and later on the person dies, you end up paying much more than when a person, the two are done by two independent companies. So there are pros and cons broadly, but we are studying this in detail, and we are studying practices across the globe. In some countries, life and health are together. In some countries like US, health companies are independent. In some countries like India, health has traditionally been a forte of the non-life companies. So there are multiple models, and we will be studying all that and taking a view if and when it becomes law.
Okay, that's useful. On now Bajaj Life, the question which I have is that if I look at the third quarter growth, the Axis Bank as a channel has grown lower than the company average, only for the third quarter. So just wanted to understand that now the market share story in Axis is almost over, and the growth will be more in line with the channel growth. And then also just wanted to understand that whether you are seeing some kind of a pressure with respect to deposit mobilization target by the bank, and that is getting reflected in bank channel growth, because overall the bank channel growth has been lower compared to the company average. So that's on Axis and bank channel. And the second point which I wanted to ask is that we had a pressure in deferred annuity business in second quarter. We see the same pressure continuing in the third quarter too. So anything to read there, because the other companies, larger companies, have also launched that particular product. Is it because of the competition or something to do or some other reason which is leading to that slowdown in the deferred annuity? So these are questions on BALIC. I have one question on BALIC which I'll ask.
Yeah, I think I'll pass it on to Tarun. The one question was on bank assurance and Axis, and is there a slowdown in growth and what is the way forward? And the second question was whether the deferred annuity business growth was because of competition or was it a deliberate strategy of the company?
Yeah. So, Sanket, thanks for the questions. The question specifically on Axis, we've maintained our market share in Axis despite not being having an equity stake from there. So I think it's that will continue. We expect our market share to hover around the current levels. In terms of the fact that whether the growth will mellow down, yes, it will grow as per the growth now of the bank and productivities that we are able to get. Of course, we always keep pursuing other white spaces where we can help the bank grow its third-party income business, and that work will always be on. And that is what will decide the growth of Axis in the future. And this quarter particularly was the quarter in which the base effect kind of annulled itself, and hence particularly in December that came back to play. As far as the deferred annuity is concerned, I know you're talking about pressure, but honestly, as far as we are concerned, we were the market leaders. We were the first ones to come up with a deferred annuity. There is a lot of residual memory about that in the market. We wanted to balance out our product mix the quarter before, and that pressure of balancing out is now absolutely out of the window, so it's not a problem at all, and we will be we're back in doing as much as we possibly can in the annuity business. It's already growing at a healthy rate, and it's grown almost by 45% over the last 9 months. So I think it's back in action there. It's grown far better than the entire company. So I think that's not an issue. The market recognizes who was the innovator, and we will keep getting that benefit, and we will be innovating further in this product.
Got it. Yeah.
Yeah. I think in the last 2 years, you must have seen that BALIC has expanded its bank assurance portfolio. We have IDFC First, we have City Union Bank, we have DBS, now we have added Punjab and Sindh Bank, we have added J&K Bank. Typically, these are bank assurance related take some time to season, maybe a year or two. And we have started building a more diversified bank assurance portfolio, and that effort will continue over the next few years.
Got it. Perfect. And the last one on Bajaj General. The motor TP loss ratio, what we look, in third quarter, it has improved compared to what it was in first half. But 82% seems to be still on the higher side compared to what we have reported in the historical past. So I just wanted to understand that given the competition is not reporting these kind of numbers, do we see a release happening in fourth quarter or in subsequent year, maybe because of our conservatism? And second, if Motor Vehicle Act benefit, given the Madras High Court judgment has come, if you bake in that benefit, what is the likely improvement you can expect to happen in motor TP loss ratio or overall combined ratio for the company?
Before I pass it on to Tapan or Raman, let me just highlight that motor TP loss ratios quarter on quarter can be volatile. Historically, we have published our triangles, and you can see that We are generally reasonably conservative in our provisioning without being excessively prudent, and we will continue that strategy. We do not comment on what competitors are doing as a rule, although we track them and we know some of the numbers with greater detail we study from their public disclosures. But I think by end of the year, you will have a clearer picture. We as a rule do not do big reversals end of the year normally, and unless there is an actuarial reason to do so, or actually as we build in enough margins for adverse deviation, we build in enough provisions for inflation in claims, we also build in provisions for any changes due to regulations such as the Motor TP Act and any developments thereafter. Now I'll just hand it over to the management of Bajaj to add any other points they feel is relevant.
No, thank you, Srini. I think you covered it. So if you look at it, and it's a very relevant question. So when you look at the overall combined ratio and you look at the reserving, then you get a very good comfort that as a company we are very well reserved. And in spite of reserving very well, our combined ratio is also among the best in the industry. That is the first statement that should clearly come out from your question that you asked. Now coming to the point that why is it like this? The health inflation the claim inflation that we see in TP, and in the COVID time, a lot of courts were shut down. So it was not very sure in terms of how the number of cases which are coming will play out. So obviously we had to keep all that provision into perspective. One was inflationary impact. Second was the impact of court closure in the COVID times, and how would these things start coming out. And that's what we have kept it. Also the trend that we see in terms of the loss ratios. So it's a full science in terms of how the reserving would be done. But at no point in time we want to be in a scenario where we would be under reserved. So it's better that we take care of our reserving by taking into all parameters and studying it well. If the court cases that you're talking about, if it becomes a trend, then obviously the long tail TP becomes a short tail, which has two impacts. One impact will be in terms of your reserving. It actually becomes more clear, because short tail you don't have this vagaries of long tail prediction as to how it's going to go, which I think will bring the results in terms of a lot of clarity of how the loss ratios will move. That is a good part. The other part will be impact on the reserves that companies have for investment. That will start coming down. So while you do this calculation, you should also see that perspective that in a short tail thing, a lot of money which companies have is the third party money which is there with them. So that starts coming down. So that's a very interesting play which will happen. But you have to still wait and watch how it plays out. But I think it will be very good for the customers. It will eliminate a lot of frauds, and it also will ensure speedy justice. So from a customer perspective, it is very good. So we welcome this if it happens. I hope we have been able to answer your question.
Yes. Thanks. That's it from my side.
Yeah. Thank you.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah. Good morning to all of you. Two questions. One, on the life insurance, that's more a suggestion. On the life insurance, if you provide complete EVOP walk on a quarterly basis, why not many do that, it will give a much better insight into the evolution of the character of the business and how the past and the present we can correlate a little better when that data is available. In absence of that, the data doesn't really become complete in itself. So that was on life insurance. On general insurance, when we see over the period of time that the character of the industry is much more focused on growth rather than growth along with profit and capital efficiency, how does it impact you as a player? Either it affects your growth or it affects your capital efficiency if you have to mimic the way industry is doing. Therefore, inadequate evolution of the character of the general insurance industry has an impact on the way you will perform. So just wanted to get the thoughts on this.
Yeah, Bharat, I will take it first up before passing on to the insurance company management. The first question, I'll take the general insurance question first. I think globally in general insurance, if you see, there are two types of players. People who seek to grow market share, and they define market share as gross written premium. And there are a few companies, maybe not more than the top decile or top two deciles of companies, which actually deliver double-digit ROEs on a sustainable basis. Most GI companies we have seen, I think last few years we have seen many disruptors entering the market, but you see the combined business they have written in terms of premium, whether it's in US or China, is a very small proportion of the market. I doubt it will be even 1% of the market. So clearly this is a business which is long term. Quarter on quarter, year on year, there can be volatility on claims, which is exposed to very large act of God risks. And therefore, what our approach has always been to follow what is prudent, underwrite well, select business well. In terms of certain businesses, especially asset-based businesses like motor, pricing can play a big role because most of the young companies start with writing motor business. That's the easiest to write and sell, which I think at some point they will run out of capital. The point is, do we want to acquire customers knowing fully well that we will lose money? Or do we want to write business where we see a visibility of profit? It is possible that some businesses may not deliver profit in the first year. But if we see that over 3-4 years we have a sustainable business to be delivered there of a reasonable scale, then we would go for that. I think the company has a very detailed long-term planning and AOP process. And it is a business of, it's very dynamic. What you do today and select or deselect may change maybe 6 months down the line if the market conditions change, as some people withdraw or some people get more aggressive. So it is that. In terms of expansion, I think Tapan can explain in greater detail what the company plans to do. But this is largely my question. On the life, yes, we have been started disclosing the EV and not the EV walk in greater detail quarter-on-quarter basis. We're also showing the 12-month rolling EV just for information. The reason we do that is because while the life business is very seasonal, with a large amount of business being written in Q4 and to some extent in Q3, but the first 2 quarters are generally very tepid. At the same time, the fixed expenses are spread throughout the year. So quarter-on-quarter EV will not be probably a good measure or give an indication as to where the year might end at, because in the last quarter pretty much there are no expense overruns are very well under control. That is the reason. However, if it is useful, we will consider publishing that from next year. We will discuss internally and take a call on that. We will do whatever the market is doing, and therefore we will go align with that. Now I'll pass it on to Tapan and then to Bharat or Tarun to take the question.
Thank you for the question. Thank you, Srini. I think you gave a pretty balanced answer in terms of how it should be. So if you look at our philosophy from the very beginning has been, it's a balanced growth. And we would be among the large companies. Having done this also, we have sustained this over so many years. It has never been a year in which everything is very comfortable in terms of the market behaving perfectly well for you to grow and all. So if you see, for us, this is normal business. I don't think that we worry about the market behavior in terms of sacrificing their profits for growth. I think it doesn't worry us because we have seen this for many years. What we are obsessed about and what is our philosophy is what we continue to maintain. As I said, our philosophy is that we should be one of the most customer-centric companies in the country. We should be one of the best claim settlers in the country. And if you look at our record with close to 13 crore customers and with close to the least grievance ratio as per IRDAI website consistently for quarters together for over a decade, if you see the numbers, then you see our philosophy remains the same, that service the customer very well, innovate the best in the market, come out with very customer-centric products, and be focused about growing business, but in a balanced way where you don't lose sight that the balance sheet gets so upset that you really cannot sustain a company which is there. So we are building a company for hundreds of years. We're not building a company for short-term basis. And in that, I think the market conduct or behavior, which to us is not comfortable, has no impact on our strategy and thinking. We continue doing so. We continue investing into reaching deeper roots into the country. Our another obsession is that today, if I divide by number of customers to the total population of the country, we will be present in about 1 in 4 households. So how can we reach every household going forward in the country? How can we serve every Indian is what our philosophy is. So these are our philosophies. When you look at our philosophies, they're very long-term philosophies. They're not very short-term or in the next quarter philosophy that we have. And we will continue maintaining our strategy aligned to a long-term philosophy, which is what. So to answer your question in short, our market will always be behaving in a certain way, and it's perfectly fine. I think that is why it's interesting for us to look at our business and continue growing, but not losing sight of our philosophies of how do we want to build businesses. Thank you for the question.
Yeah. So in short, what you are saying is adverse or inferior behavior of some of the players in the industry will not cause a damage to our long-term
No, sir. We should not worry about how others behave. It's about personal life also. It's about business also. I think our obsession should be how we behave, what kind of character ethics that we have, and how do we keep on building on it. The market will keep on changing. It will keep on behaving in a different manner. I don't think we should be very worried about how the market behaves.
Great to know that, because at times you develop a concern whether in the quest for competitive behavior will it alter the way we want to pursue the things that are. And on EV OP work, idea was not merely to get a quarter-to-quarter insight. It is basically to get insight into how the company is doing the business over a period of time, and therefore correlate past to the present and basically see how the future is shaping up. It's more from that perspective that when you have a series of data points over the period of time, you get a faster judgment as to how the company is using its own insights appropriately. The other question was if we look at last few years, can for life insurance as well as general insurance, can we say one or two things that we feel when we reflect either we could have done better or faster, both in life and general insurance?
But can you repeat that? Was that a question?
Sorry?
Oh, was there a question at the end?
No, that was the question, that if we reflect over last few years,
yeah,
what are one or two things, both for life insurance as well as general insurance, in our opinion, we could have done faster or better?
Okay. If you ask me, I think I will answer that question. I think in general insurance, I think we have done, I'll say what worked and what we have done exceptionally well and what we haven't, or where we could have done better. What we have done exceptionally well is our very strong bank insurance tie-ups. We have more than 240 partners. Most of the bank insurance business is commercial, and we have been growing those lines much better than the market. And we believe in the long run, commercial lines are a very important component of a PNC portfolio. They give both property and casualty business, as you say. And it also gives you large exposure to MSME and SME business, which otherwise is very difficult or very expensive to acquire. That is one definite plus point. Secondly is the overall balance of the portfolio. We have not shied away from any line of business, any distribution channel. We are fairly strong players in bank insurance. We have a strong multi-line agency network. We are one of the strongest OEM tie-ups for new cars. We also have a strong presence in the e-commerce-led businesses. We do small ticket mass business. We do large ticket corporate business. We have outstanding reinsurance network, as we believe. And therefore, these are some of the very good things which have been drivers of profitability. What we could have done better, in my view, is that, yes, there could have been a little bit more traction on retail health. We still are not very clear about the profitability model for retail health because it does not generate float, and you have to operate at about 92-93% combined ratio in order to be able to deliver a superior ROE. That at the moment is not available in the market, and it is an aging portfolio. The price is, while not controlled, is still subject to approval by the regulators, and there is a big social impact there. So in terms of health, as I explained before, we have done exceptionally well in group health business, which today is delivering a combined ratio below 100 and growing at more than 40% in this quarter. Overall health, both group plus retail, we become one of the larger players in the market. As long as you are the strongest player over time, we should be able to demand better terms from hospitals. At the moment in India, the insured use of hospitals is much less than the non-insured use, and therefore insurance companies tend to pay much higher than what individuals pay for the same claim. That has been our experience. If you look at even COVID, the average COVID claim was about 115,000 rupees for the market. This is as per the IRDA complete statistics of the market. At the same time, the non-COVID claims are hardly 60,000 to 70,000 rupees, which includes your cancer and cardiology and all. So clearly there has been some aberration because of that. It is some area where we are now investing. We are now continuously look at profit pools, and the larger cities we believe is competition is so intense that we need to use our financial strength, our balance sheet, and our ability, our customer service to be able to expand our business into tier 3, tier 4 towns. There are a lot of regulatory changes which may enable us to do that in terms of a single composite limit for expenses. There are going to be some digital properties like Bima Sugam, Bima Vahan, and we already are present in many of those markets through crop insurance, through CSPs, and our rural and other outreach businesses. So we think this wind of intense price competition will correct itself over time. In the meantime, we have to continue to do what is good. One good feature of us is that even the last 4 years, our share of the industry's profit continues to be very strong. We probably deliver more than 30-35% of the industry's profit even today. And that is very important for us. Our solvency is very strong. Today, Bajaj itself has a surplus capital of more than 5,000 crores, and they are looking to increase dividends as we go along. So I would say retail health is an area where we want to focus and rebuild. The other areas on the commercial insurance is something where we want to maintain our strength, corporate and commercial businesses. On motor business, we want to be cautious and focus more on two-wheelers and select parts of commercial vehicle business and older private cars. In terms of life business, I think pretty much everything has worked. We have used our surplus capital to good effect to build an industry-beating performance over the last 3 years. We have gone from a negative margin after overruns to a significantly positive margin. Our NBV has been growing for the last 4 years much faster than our premium, which itself was growing significantly above the market. We have built a strong proprietary sales platform. We have our agency is now delivering double-digit margins. And in terms of bank assurance, where we had practically nothing to speak of 5 years ago, we have now a set of partners. Clearly, what we could have done better is probably on the term life, which is a high profit product. We could have probably done better. Unfortunately, COVID took us back, but that is just a reason for not doing it. We could have done it maybe 2 years before or later. But now the company has a defined focus, as Tarun explained, on pushing the percentage of term into the total. There are a lot of risks associated with term, especially writing whole of life and long-term businesses, because there is always the pressure of underpricing and then the claims hit you after a number of years. But we have very strong reasons to believe that reasonable traction can be obtained on term, which can alter the margin. So in terms of balance, they have done remarkably well. In terms of building more tires on the institutional side like bank assurance, it is still work in progress and we can do far. I don't know whether we could have done it faster, but definitely we will continue to focus on that. And thirdly is to improve the efficiency of operations, where we believe there are some pockets where we can further improve the efficiency and deliver a better result. So largely, this is how we see it. Unless Tarun and Tapan want to add something to it.
Just concluding it. Sure. I think you have done a very good summary, so I'm perfectly fine. I agree. I think you answered it well.
Thank you, Bharat.
Thank you. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity. So firstly, on the general insurance, we have been doing 20% ROE in the past. Now, the competitive intensity, I understand, is quite intense in the motor segment. Probably because of that, the ROEs have now dipped to 50-60% for the 9 months. So in your experience, for how long this competitive intensity is likely to remain intense? And consequently, when do we see ROE trajectory improving to 20% level that we used to see in the past?
I will take that question first up. I think 20% is a number. I would not really say it is competitive pressures that has reduced the profitability. I think we have had 2 years of COVID claims in which Bajaj did very well to have a very lower percentage of exposure to COVID claims than their overall market share in retail and group health. And now I think as the market came back, there has been what is called a sort of pent-up demand or in terms of cars on the road are at an all-time high. The risk of driving has increased substantially. The non-COVID health inflation has caught up quite a bit. And there is that one-time effect in this year that you have seen in terms of claims, as we explained very well in Q1. This obviously cannot sustain. And we did increase price just before COVID as part of our normal actuarial increases. And we believe some of the other competitors will now be forced to look at price increases, is what is reported in the press. As they increase the prices, that will also stabilize. So therefore, I do not see that if this year is 15 and next year is 20. See, this is a very volatile business. Globally, if you see, nobody makes consistent ROEs in this business unless they give up growth or there's no such profit pool available. It is a market which follows what is called the underwriting cycle. The underwriting cycle globally is very well known of a period of high prices and then losses mounting and then prices hardening and therefore companies soften on growth. In terms of the reinsurance market, you find a lot of companies going under as well. And then the market corrects itself and comes back. This is completely different from the investment cycle or a business cycle. And this is the beauty of the insurance business, and therefore the cycle has to play itself out. In a retail market where new competitors are entering, obviously price competition will be felt in the easy-to-sell businesses, and therefore one has to look for alternatives and develop those lines in a more profitable manner and build the right skills, capabilities, and risk management. Our endeavor is to do that. I cannot say that we have reached where we want to, but it is work in progress. And through our long-range planning and annual operating plan process, we continue to improve. Substantial improvements have been made in digital outreach to customers in terms of digital experience on claims. And we will see as we go along. We also are now focusing a lot on loyalty in general insurance. Very fickle general insurance customers globally are very fickle that the best service does not necessarily mean the best loyalty. The best combination of service and price and engagement will deliver that, and that project we will see will evolve over the next 2-3 years in a more meaningful manner to all our premium customers.
So there's a follow-up. So are we seeing any signs on price hardening and cycle correcting over the next 12 months, 18 months, or still there are no signs?
Thank you, Srini. I think that we have to wait and watch, no? But if you again look at the industry overall, and I'll take it to year 2007, when pre-pricing happened for most of the lines of businesses, From that time, industry has been operating at a combined ratio, which is not very good, I would say, for 16, 17 years. So as I mentioned earlier, I think that there would be, like you mentioned, there would be cycles, but it has to somewhere settle down. But will it happen in the next 12 months? I cannot comment on that because we have to wait and watch how it goes. It depends on the appetite of people, upon the capital that they have, the strategy of how they would like to behave in the market. So it will be difficult for us to predict in terms of how the market will behave in terms of price correction in the next 6 to 12 months.
Sure. Secondly, on life insurance, we have seen pretty robust growth in retail protection in this quarter, while peers are not able to show growth. So what we have done differently which has led to such sharp growth, and how is the growth outlook in retail protection for FY24 for us?
Yeah. So, we've grown faster than peers, and I think we shall continue to do that. I think we should expect that at the bare minimum from BALIC. What has really worked for us is really the way our agency and the BALIC direct channel has particularly ramped up. And of course, in institutional business, the scale-up has been happening for a few years. That's really helping. And going forward, we also start protection, retail protection, which has become a strong part of our direction to move ahead with, to be more and more prominent. I think that's where we want to really make a difference. The good thing is that underlying all of this growth, I think the big thing which is not getting picked up so often is the number of policy growths that we've had. I think that was the one question I was asked about 9 months back. If there was something we wanted to correct, and that was the one thing we wanted to correct. And while a lot of life insurance companies are focusing on increase in per ticket size, we maintain a robust ticket size per policy, but scale of customers, the number of customers we add, is something which is critical. At the same time, keeping our ticket size growing with inflation, and that is what is more and more to expect of us in the future as well.
Sure. And lastly, just 2 common questions for both companies. One is commission regulations. Commission is expected to be deregulated for both general insurance and life insurance next year. So do you see any implications for our business because of that? And lastly, Bajaj Finance has come out with long-range strategy where they've shown aspiration of over 5 years. Do you have plans to share similar long-range strategy for life insurance and general insurance business?
Tapan, would you like to take that first?
Yeah, thank you, Srini. So I think it's a good move in terms of deregulation of commissions, because typically if you look at when this commission regulations were established, it was an era in which the only distribution was agency. So now you have different distribution, like to banker, to direct, to web, which would require, some would require more commission, some would require more expenses to be had, and that should be left to the companies to decide how to play out within the expense of management limit. So I think that's a very progressive move by the regulator, and it is going to benefit in terms of establishing different modes of distribution and putting it together. So I don't see it as a major impact coming through in terms of our strategy or lines, but I think it's a very progressive step, and we welcome that going forward. The second question was on, sorry?
On the long-range strategy, 5-year strategy, which yeah, so the group companies.
I think Bajaj Finserv as a holding group, we, along with Finserv, we engage in setting up AOP, LRP for all the group companies. I think that's a phenomena that we do it together. And whether to disclose or not, that's a call we can take later. But to give you an assurance that every company in Bajaj Finserv group company has this long-range plan and AOP, which they would be establishing every year. It's a process which is that sort of getting businesses on.
Does that answer your question?
Yes, that's it. On life insurance, do you expect any impact because of commission regulations?
See, I think quite well answered by Tapan already. I think the only added bit to all of this in the UM guideline, which doesn't seem to catch people's eye, is the positive, which while capping the EOM very much to the current limits, there is a proviso in the new EOM guidelines. Let's see how they come out, but there's a proviso there where any reduction in EOM, we have a portion of it has to result in benefits going to the customer. I think this is something that most people miss out on. I think this is a very forward-looking step that IRDA has taken. So it's not that something you want to give extra to the distributor, or for that matter, even the company would want to keep. But IRDA is insisted that a part of that has to go to the customer. I think all of that enveloped is a pretty positive, progressive movement from IRDA. It will help the life insurance sector as well.
If I can just add to what Tapan and Tarun said, what will happen with the expense cap is that, let's say there are people who come into the market and who want to gain market share. Today, they spend a lot on expenses and try to gain market share in whatever that is easier to sell first, and then they graduate onto more complex businesses. This is typically the strategy of any company, whether it's in life or GI. Now, with the expenses being capped, they get some leeway for the first 5 years, but thereafter, they will have to then focus on good underwriting. Which means that the only way they can take market share away is not by spending more money, but it is by taking more losses. Either you underprice or take higher claim ratio or take higher guarantees or whatever, depending on the type of business. That is a recipe for disaster, because that is like saying that a bank will take market share by taking a lot of credit losses, but by keeping its OPEX under control. I don't think any financing institution can work like that. Similarly, in insurance, it cannot be like that. And ultimately, whatever the limit is, the companies have to spend a big portion of that in customer service, in managing grievances, in managing third-party courts, and depending on the business, there are a variety of things that they need to do. So therefore, this will, in the long run, support businesses building good brands over long run, building quality business, focusing on customer value and customer service and customer engagement. This is broadly the theme. In the short run, there will be a lot of disruptors and tailwinds, and we just have to see that we tackle them properly.
Sure, sir. Thank you, sir, for your answers. Thank you. That's it from my side.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I would now like to hand the conference over to Mr. Samir Bhise for closing comments.
Thank you, everyone, for joining this call today. And also, big thanks to the management of Bajaj Finserv Limited for giving us this opportunity to host the call. That ends the call here. Thank you so much.
Thank you all. Thank you, JM. Thank you, Tapan.
Thank you, sir.
Tarun, Raman, Bharat. Thanks.
Thank you.
Thank you, everybody. Thank you.
Thank you. On behalf of JM Financial, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.